Have you ever felt a huge blood rush whenever you're in a trade? Or have you been in a trade and it's already going in your favor, which means you're already in a profit, but you're skeptical of remaining in the trade and you feel like you should just take the little profit and leave the market because you're not sure if the market is going to go higher any further or reverse and turn against you? Have you also been in a trade where you are losing a bit of money, but then the market has not quite gotten to your stop loss price line, but you are eager to leave the market because you feel you're already wrong and that the market is going against you and the market may take out your stop loss and you do not want that to happen? Have you ever felt that enthusiasm and blush rush flowing all through your veins whenever you're in a trade? Has your heartbeat ever pumped so hard that you could feel it pounding and then you feel like, wow, you are just eager to either cut your little losses or take a little profit and have your peace of mind? Have you also been in a trade where the trade is going against you, even it has hit your stop loss price line, but you refuse to get stopped out by shifting down your stop loss or by cancelling out totally your stop loss, so the market continues to go against you and you feel the huge or the need to keep adding more money because you do not want to take the loss? Which one of these scenarios best describe the type of trader that you are? Are you the one who doesn't want to accept the wrongdoings or that you are wrong in the market? Are you the one that whenever you are in a trade and it's in profit, you are eager to get out because you do not want it to reverse and then go against you? Or are you the type that, yes, you follow all the rules, you have your entry, you have your stop loss, but the moment you get filled and a little red against you, you're already eager to get out because you are not sure if it will reverse and go your way or it will go for your stop loss, and then you do not want to lose the amount you are willing to risk, or you do not want to lose your risk, but then you want to get out quickly with a little loss? Which one of these are you? Good morning, guys. My name is CryptoKeep, and today I will be discussing all these scenarios which I have pointed out in the intro of this video. And I have done series of videos about emotional trading, as in trading with emotions, and then psychological trading, and also risk management, which is what these videos also entails. So let's see what actually we mean by having blood rush in a trade. There are several people who, wherever they are in a trade, and assuming they have their entry, like assuming they have this zone as their entry zone, and they have their stop loss just below the entry, which is around here. Assuming they have their stop loss around here, then they spot the market coming down, and then they get filled in at this point. And the moment they get filled in, the market goes down a bit into the zone, which is their total buy zone. Here is where they have their hard stop. But then seeing the market not reversing instantly as they wish, but going down to take more orders, they feel they are already losing too much. And they are already fearful for their stop loss, which is here. So they sell the trade at this particular time, just to lose a little than lose all the money they will have lost if the market has gone against them and take out their stop. But after they close the trade in a little loss, then they just realize that the market then reverses and go to the upside. Are you this type of trader? Then we have another scenario where we have traders, once they get filled, they have no stop at all, or they have meant to stop, which they want to play their stop here once the price closes above this price line, or once price goes below it, below, then they want to stop out manually. They do not have hard stop, and then they're in a trade, maybe they have little profit, and then the market comes against them. What should happen here immediately? Price goes below here. Yes, they should close the trade, but then they become fearful. The market has given them a little profit, and then it comes back to hit their stop loss price line, which is not what they want. So instead of stopping out, they feel they need to keep adding money. And if the market keeps going down, they keep adding money. And the bad side of doing this is that the market may keep going down till God knows when. Even if you keep adding money, what you are doing basically is you're averaging your entry. You have first entry here, probably you have another entry here. If it's 50 of the size, as in you have $100 here, you put another $100 here, then the 50% range is where your average entry will be. So once price is still here, you are still losing. And if price goes down again and you add more money, then average of year to year. But then remember that the more you're adding, the more what you have stocked up is increasing. So you should also be increasing the amount you're adding. If you keep adding less, like $100, $100, then your entry will be far away from where the current price is. So once you get at the end of the day, probably you have an average entry which is in here and price is somewhere trading around there. And you have a huge journey for the price to travel up before you break even. What happens to when you run out of funds in the bank? When you no longer have funds to keep adding to the trade. And then the funniest thing that may happen is price may come all the way from the downside, gets to where just a bit shy of your average entry, and then turn back to the downside. And then the last type is people who have trades and then they get filled in and then they are going into profit. But then the first sign of downness which they see, they get out because they feel the market is turning back and it's going to continue going down. Rather, instead of them to believe or assume that this is just a little pullback for this movement from this point to this point, only for price to continue higher, they wouldn't. But then they accept to take this little profit and miss out on the entire profit which they initially planned. So what does all this thing lead to? All this taking trades, having blood rush, not taking your losses, it all has to do with risk management and trading plans. Now, if you have a trade plan that you want to take an entry at this point and your stop should be at this point, that is where risk management comes in. If you have $100 on your account, how much can you afford to lose from this $100? Personally, I may say, okay, I'm willing to risk $20 out of this $100 balance that I have. Another person may be willing to risk $10. Another person may be willing to risk $5. Another person may be willing to not risk more than $2 or $1. We are all different individuals, so our risk tolerance are different. So whatever your risk tolerance is, if I am willing to risk $10 out of this 100, that is because if I get to lose this $10 on this stop loss, I wouldn't feel it on my balance and I wouldn't feel it psychologically. It's like losing an amount you can easily lose in your real life every day. If you have $100 in your wallet and maybe you misplace $1 or $2 or $5, you won't care. You won't even bother to look for it. That is how you should also trade. If you have $100 and you are risking $50 from this point to this point, if you miss or you lose that $50 to this point, you will feel it because that is 50% of your capital. And if you take another trade with that $50 risk and you lose again, then you are liquidated on your account. But if you risk $10 from a balance of $100, then you have at least 10 trades to take before you can lose your entire capital. Now, it's not guaranteed that you will take 10 trades and lose all 10. Likewise, there is no promises that you will take all trades and win all trades. The market is full of probabilities. And it's like a bet, right? You do not know the outcome. But it is a better bet because you can calculate your risk and with technical analysis, you can see where to go in, which point has the best probability of going higher which price line has the best probability of sending price back towards my direction. If you are going short, looking at this price line, which of this area has the best scenario to push price back down? If you are going long, which of this price action line has the best scenario to push price up? So at that point, you do not know if you will go long. You do not know if the trade will play out to your favor or against you, but you are taking a high probability trade based on your analysis that, okay, this area here, when price comes back here, I have strong belief that the price will go back up. Then why shouldn't I bet on it? And if I want to bet on it and I have an $100 balance, if I can afford to lose $10 to this trade, then I should risk my $10. If I can only afford to lose $5, then I should risk $5. Do not go all in with 100. That will give you just one trade if the trade goes against you. So how do you then calculate your risk? Now, you know, I want to risk $5 on this trade. And $5 is just 5% of my balance. So I have 5% of my balance, or I have the $5 that I want to lose. Then I take the percentage from my entry price to my stop price. That is a minus 10.01, but let's use this as 10%. So I have this 10%. How do I then calculate the position size that I will go long at this particular point, and whenever the price goes against me up to this point, I will lose exactly $5. So that is where your position sizing comes in, and that is also part of risk management. So here you have your risk. Your risk is $5 from your balance, which is 5%, right, of your balance. And then, I don't know if you can see this, let me increase it a bit. Okay, so then your entry distance from entry to stop is 10%. So your risk, your position size will be what? So this is where your mathematics comes in. You just have to do the little math, and then you have $5 to lose, then divided by the distance between entry to stop loss, and that is 10%. Divided by 10%, that is 0.1. And then at the end of the day, your position size will be $50. Now look at it. We have said if you year to year is 10%, right? This is not correct. I'm not getting it correctly this time. But then if you place a trade of $50 into this position and you have your hard stop loss here, $50 minus 10%, how much will that give you? Let's do it. $50 minus 10% of $50, that is 5. So that means 10% of $50 is 5. So if you enter at this point with $50, remember, the leverage you are using, that doesn't matter. If you use 1S, or you use 2S, or you use 50S, it doesn't matter. Where you will feel that is on your liquidation price. But if you are using, let's assume 10S, your position size remains this 50, then your margin price will only change. And sorry, let me use this rather. So your margin price will only change. What you will see with your margin is, margin will then be that $50, which is your position size, divided by your 10S. And your margin will be $5, because margin is size divided by leverage. So the leverage you use doesn't matter here. The leverage you use doesn't matter here. So you can use 1S, you can use 2S, but what really matters is the amount you are willing to risk from year to year. And now, if you have accepted that you want to risk $5 on this trade, so if the trade goes against you, you are losing just $5 from your account, and you have $95 as your balance, then what happens next? You get in on this trade, and the moment you are in on this trade, At this point, where is the 50% of year to year? That should be around there. So at that 50% point, if price comes there, then you are losing $2.5. If price comes here, you are losing $5. So what happens if you refuse to take your losses here and accept that you are wrong, and then the price goes down a bit against you? Then this, you are losing $5 at this point, but you refuse to take the loss. Then at this point, you are probably losing 7.5 or $10. Are you getting the point now? So if the move from here, let me measure it, from here to here, you have to lose $5. Then the move from here again to this point means you are losing $10. So if you keep adding money or adding more size, so more position size, you keep adding money to the position, your balance is reducing because your margin is also reducing. And then what will happen is that your liquidation price will keep coming up. So stop loss is very essential in trading, especially when you use risk management. Because if you do not use risk management and you just use 10% of your position size alone with whatever leverage, then you are using 10% of your size, which at this point you will have to calculate how much you are losing. But the moment you calculate it this way, if you calculate to raise 10% of your balance, that means your position size will be 100. And at this point, you will lose 10. So if you allow the market to go against you, the more you are losing more money. And it becomes greater and bigger the further it goes down. So why would you just accept that you are wrong on this trade and then look at what went wrong? That is where you have to know market structure. Because when you trade with market structure, you will understand one thing. And this is the thing you will understand with market structure, that you have movements in waves like this, and you have your invalidation price at this particular low. So if you are willing to buy at this point, or rather you have an OB at this point, probably you have an OB at this point, which broke this high, then price is coming back down, then you take a trade. Maybe the invalidation or the stop loss on that OB is at this point, and you get stopped out here. Then price comes to this low, make an higher low, and then reverse. Then you complain. So next time you do not want to use stop. This is where you have to know market structure, that the trade on this move or the movement from this price line to this price line is only invalidated when price goes below this low. So if you have a demand or support and resistance or other block at this point, and you are placing your stop here, then that is a very wrong way to place stop. So you have your other block here, or maybe support and resistance at this point. So you expect price to come into it like this and then go up. But then you have your stop loss here, forgetting that until this very low breaks, that is when the long idea or the long bias on this trade is invalidated. So what do you want to do? If you're taking an entry at this point or at this point, you want to have your stop below the invalidation level. And you are going to do that and calculate that to know how much you will risk from this point to this point is where you have your risk management. Either you are risking an amount from this point to this point. If you risk to lose $5, you will lose $5 only when the price goes or comes in contact with this, your stop loss here. And if you are risking from here to here, you choose to lose $5, $5 is the amount you will lose. No matter how big the stop is, if you calculate, you just have to know the size, the distance between your entry to your stop and the distance from another entry to your stop, and calculate your position size. So if your zone is very tiny, as tiny as this, if your zone is very tiny, as tiny as this, or it's as big as this, if you want to lose $5 here, you will lose the $5 when the trade goes against you. If you want to lose $5 here, you will lose the $5 when the trade goes against you. The only difference between this point, this trade and this trade, is that the position size on this one will be far bigger than the position size on this one. and looking at the size of these two, which one has the higher probability of taking your stop loss quicker? It is this one, because this distance from entry to stop is very minimal. So all you have to do to avoid all those blood rush is accept that you are entering this trade. Yes, it is a probability. You do not move the market. 99% or 90% to 99% of trading it requires patience. You have to wait. It's a waiting game. The moment you get in on this trade, you have to wait for the market movers to move the market in your direction. If you have the money to move the market, then you wouldn't need to do any analysis. Just get in at any price point because you know your money will move it. People will see the action you are taking and they will follow suit. They will do what you are doing, and then price will move in your expected direction. But here, you have to wait. There are a lot of uncertainty. Price may come down and choose to break this zone, which is why if you are going into a trade, accept that trade as a loss. I'm not saying it is automatic that you take it as a loss, but just accept the trade that, okay, there is probability of you losing this trade. So risk only what you can afford to lose. And the moment you risk what you can afford to lose, place your stop loss. Because if you place a $10,000 position on this size based on the amount you have chosen to risk, if you do not get stopped out at that point, you keep losing huge money. And like I said before, when you expect the market to reverse, probably this zone breaks. And then there is a supply around there. And this is your entry. Then you expect the price to come at least to this supply. What gives you the guarantee that price will come back to this supply? Price may never reason that supply. It may come towards here and use this as a breaker or something, and then comes back. And you will remain in the trade in even more bigger losses. And probably your liquidation price is just around the corner. So accept the trade as a loss, that you are likely to lose this trade, even though it's a good setup. That is how you keep your mindset in check. And then when you are in a trade and the trade is going against you, if this is a take profit, endure, make it a do or die. It's either you get stopped out or it's either it comes to your take profit. But there are sometimes in the market that we have seen, here might be your take profit. We have seen price come down, up, down, and just a bit shy of your take profit, only to then reverse, breaks another invalidation, and then keeps reversing to the downside. This do happen a lot, which is why you want to use the first trouble area to get out. You might have your trade here, and when price is coming down, it comes down with probably support and resistance. So let me clear this. Okay, I think it's better now. So what I'm trying to say is price now is coming down like this. What have you noticed at this point now? You have noticed like a support around here. So price is respecting support and resistance at that particular point. And then price may come down again, find support here, and then break it. Then now you are filled in. Right. This might be your invalidation level. This is an emphasis, right? Not an analysis of the truth or of why it is, just an emphasis. So if here is your invalidation level on this trade, and then you see price coming here, you have a support here, support here, support here, and then breaks. What do you expect? And now you are filled in. You expect price, maybe your 3R from, if you are going for 3R is here, maybe your 3R is at this point. So your take profit target is at that point. So what are you trying to do now is, so again, let me quickly roll this support line. So now here, this point here is your target. Oh, sorry, that point there is your target where you get your 3R or 4R or 5R. But then you have noticed something here, which is support. And you know from the rules of support and resistance, it says support once broken turns resistance. Even though it might break up again, like this, and then find support here again to come back to your profit target. But then this area here is a trouble area, which can give you an insight that price may change, because you are expecting price to come to this area, but then there is now a resistance at this point. So price may likely come back here and then break here and continue to go to the downside. Which is why sometimes when you see that the trouble area is too close to your zone, you may not want to take that trade. Or if you want to take that trade still, then if this trade is on the 4-hour, then you want to go to probably the 30 minutes or the 15 minutes, and then you watch for confirmation on that entry. And the moment you see structural breaks or trend line breaks on your 15 minutes, then you want to take the trade. So assuming you have on your 15 minutes now, you have this trend line root, and then price comes into your zone and then breaks this trend line with a close to 3 close above it, then definitely you know that this price is ready to reverse. Then on retest, you want to go long, and that is because you are seeing this resistance point here. So you do not trade blindly because the market can turn against you, and sometimes you do not want to be so rigid that 3R is 3R, and then you are waiting for 3R, even price may be making 2.5R, and then you get stopped out. So that is it for if you're in a trade and the trade is going in your way. Or rather, what you can also do is assuming you're in a trade on this point now and the price is going in your way. And the moment the price moves from your entry to a considerable distance, you want to move your stop loss from this point to break even. So if the market eventually turns against you, you wouldn't lose any amount. But funny enough as well, most times price will go up, come back to the same entry again, won't quite go to your stop loss, but then come up. So you want to know how best to manage the trade. Probably when you're in 1 hour, you still want to leave it at your stop loss area because market can easily come back down for a quick retest before going up. Then once you are at 2 hour, then probably you want to move your stop loss to break even. You just have to find the best way or what best suits your need in order to plan your trade and manage your trade. Then another thing is I've talked about not using stop loss. You know, that is very deadly. Sometimes if you are using mental stop loss and you want to see price close below this, one price close below it, take the loss. Accept that you are wrong. Then look for what has happened. And that was what happened to me on this coin today. I was trading this coin, this particular coin, on the 30 minutes. I took a trade on it. I'm trying to find the area again. I took a trade on it. Then, okay. Then I exited in profit and I was waiting on the 30 minutes for this particular trade here. It wasn't coming. As you can see, we have some lackluster price action around this area. Distribution, right? So when this was forming, I then went to the 5 minutes to see what was going on. So what I saw, I drew a trend line like this. Okay, like that. Not up to this extent. Price was around here then. Then the moment this price, this trend line broke, I saw my demand. I don't usually trade with trend lines, but then I just wanted to take a trade. So then what happened? Price came into the area. Now let me remove this. Price came into the zone and then it went up. I was going for 3R, and let me use my R to demand R. So here will have been 1R, 2R, and this will have been my 3R. So I have my take profit at this particular point, which was 3R of whatever I'm risking here. And then price came in, filled me in, rallied to 1R instantly. As you can see, price came back just a bit shy of my entry price here. I don't know if you can see that. This green candle was just a bit shy. Let me remove this now. So this candle was just a bit shy of my entry. So that was what I was saying, when the price may come back again before going up. So if you see this first red and you exit, then the moment this price came back and then comes back up, you miss all this profit you have given a lot back to the market with impatience. So price then came here, which was very close to my 3R. I was seeing hesitation, but what could I have done here? For price to have closed below this particular high, it means first sign of trouble, right? When you study price action. Then I didn't get out, and I didn't even use stop. I was using a mental stop that if price goes below this low, then I will stop out. But then seeing price coming all the way from my entry here to just a bit shy of my take profit and then coming back down due to BTC. BTC was reacting badly at that point, not so bad, but this coin was low liquidity, so it reacted a lot worse. And what happened at this point? The trade went against me. I didn't stop out. I was holding my stop loss. I didn't even think of getting stopped out on the market. Why? Because I had a much lower entry. I had a 30-minute zone, which is here. I had this entry in mind. This was my original entry. So this was just a risky trade I took with a little risk. So I wasn't considering that risk. And then when the price came against me, see what happened? All the way from here up until here. That is a 5% move. And I was up on this position, starting with around $30,000 on this particular position. Then what happened? That was on two positions, right? On the same coin, but two different accounts. So then all this started coming down. The losses on my account was huge. I was like, wow, okay, I'm just praying that price comes here and then reverses. Because once price takes me in here, I will have an average entry. And my average entry was around here. So I was waiting because sometimes, like on this week, price came to where would have been my average entry and then came back up. I could have gotten out if I was taking a trade here, but I was here waiting. And price, there is no guarantee that price will come here. Price may come all the way from here, get close to it, and then reverses. I may not even get up to here, or price may come all the way from my entry here, as I am losing very big here, comes to a bit shy of it, and then start ranging for God knows when. So I will continue to be in loss, and my new entry is not getting filled. So I was praying that I should get filled. And the moment I got filled on that trade, I was happy. That was my average entry. So I was happy. Then here I had to go in with around $70,000. My total position size was $100,000 on these two trades, two different accounts. One was 70,000, one was 30,000 in total. So total of $100,000. And imagine what happened the moment I got filled here at that price line, and then price was coming down to this point, just a bit shy of the invalidation lows here. Even though I may have my stop around here, but considering that I am in a trade from here, and here's my average entry, and price is here, all the way from here to this point, I was losing a lot. I was losing more than $2,500 then. So I was like, wow. Anyway, I was looking at BCC also. Then I was like, I was also feeling the blood rush just because of my refusal to get stopped out on this trade for a little amount that I might not even feel. And then I will have entered here on this trade I was waiting for peacefully, and then I will have taken my 3R, which means whatever R I have risked here, I would have recovered it from this trade. But then no, I was skeptical. I was like, I don't want to get stopped out. I don't want to be wrong. And I was only lucky. The first green sign which came above my average entry here, I got out here. And then what happened? Price then came down to retest the entry again, which also brings that retest of entry the moment you get filled in. So you may get filled in, price will rally up, and then come back to retest the entry again before going up. I wish I had waited and not rush out immediately because of the amount I was seeing that I was losing. So the first point of getting a little profit of this market, I took it. But if I had waited, with confidence that this my zone will work. Then I would have even made a lot more without this move. But look at this again. This point here, the price or the lows was quite close to this invalidation, which means this price ate deep into this zone. So the moment price comes down from here, it may just decide to take this out. And if that happens, then what do you think will happen to my position? It will go in very huge loss. And then my liquidation, because I added money to the position, my liquidation came all the way from, was it $16 on this coin, and it came to $50. Now imagine that. If you have your liquidation, if you have your liquidation around here, yes, and then it came all the way here, $50 here, and it came towards $50 because I added more money. Have you seen the distance? And that is because I refused to accept the loss on that trade, which was quite wrong of me to do. So that is the essence of risking an amount you can afford to lose. Even though I was risking the amount I can afford to lose, but then I wasn't willing to be wrong on this particular trade because the market has came close, or the market came close to my take profit. So why will I lose after I've almost taken profit? I could have taken that 2.7, but I didn't. So why should I lose this trade? Anyway, I'm waiting here for the market and see. Let me quickly clear this and see what happened. Okay. And see what happened. Where is the trade again? Okay. I wish I have entered the market with my clear head without the blood rush from the losing trade from this up. Look, I go for 1 to 3, all right? This 1 to 3. At this point, I will have been out, and I do trade my stop from here. I trade profit from here. So it's possible that I ride the trade up to this extent and make maybe 3 point something out for her. But then I wasn't even on my clear head because I have refused to accept my losses on the trade I took here on the 5 minutes. Because at this point, I will have my stop either here or just a bit below it. And the price never came even to where my stop loss would have been. And I have my 3R. So that is the essence of trading with risk management and planning your trade, and risk only what you can afford to lose. And whenever you are going in a trade, accept the loss. It's like a football match. When you bet on a football match, you are just enthusiastic that my team will win, but you are not certain because every day is not the same. Something may go wrong. Likewise in trading, you may see a perfect setup at this point, but then something may just go wrong. So accept that this trade, as much as I love to win on it, I may lose the trade. And in the case I lose this trade, how much will I be okay to lose without crying, without having emotional trauma, without having psychological trauma? Risk that amount alone. And when it comes to your stop loss, do not blink. No, okay, this has gone wrong. Reassess if the market has turned bearish, or if it's still bullish, then look for another trade and take. And if you lose, assuming you lose $5 here, from here to here, from here to here, then you will win like $15, which means the $5 loss has been recovered. And when you remove the $5 loss from here, you have a $10 profit. And that is all thanks to risk management. So you do not have to even have higher win rates, but when you win, make sure you win multiple of what you have lost. So I believe this video will be quite useful to some people who find it interesting. And then that is it about psychological trading and having blood rushes and having your heart pumps while you trade. So thank you for being with us, and do not forget to subscribe to the channel. Support us now so we can at least continue to help people. All this we do is for free, and we try to help people as much as possible. No one is perfect, and no one will be ever perfect, but we can always find a way to assist and help each other so we can grow together. Thank you for watching.